Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Hey, everybody. Welcome back to the Working Wealth Podcast. We're so glad to have you for a special two-part edition of our show here. Joining me today is not our regular host, my wife, Haley, but we have a slightly less attractive.
Very much less attractive. It's
but equally as fun friend, our local auto and home insurance agent, Mr. Tim Gajda with Five Forks Good Neighbor.
Yeah. Thanks so much for having me. Excited to be here.
Yeah, no, we're super pumped to have you on, and especially like with these episodes we're recording, probably not going to go out immediately, but it's very, very relevant for the content we're talking about today.
Very timely.
Yeah, because we've just had a month ago was the
Has it been a month already?
Yeah, it's kind of sad to think about,
Aye,
right?
aye.
I feel like it's been 17 years already.
For what we've had to deal with, it feels like it did just happen, but it doesn't feel like it's been 4 weeks.
Yeah, it's kind of like having a kid, right? It's like the kid's here, and then all of a sudden they're, in my case, 17 months old. But time flies, right? But let's tell them what actually happened, right? So we had Hurricane Helene came up. Keep all the conspiracies aside for today. Came up right through southern Georgia into South Carolina, North Carolina, and caused massive devastation. Mm-hmm. And it's part of the reason why we wanted to get together today and talk about specifically your professional industry and insurance and a lot of things that people don't know about, things that people need to know about and understand, and how to handle situations like we have right now.
Sure.
So that being said, as a little intro, Tim, tell us a little bit about yourself. Backstory, as they say.
Personally, I had a wife and two kids. I got two 11-year-old sons, Cooper and Jackson. Mm-hmm. My wife, Bree, we've been married for, she's 16 years this year.
Better get it right.
So I know, 16 years in December.
But how long have you been together?
Let's see. I always have to go by age on that one. So for me, 23 years, 22 years.
Which is incredible because you're only 24 years old.
Yeah.
Right?
Well, 38. But yeah, I wish I was...
Which is a lot closer to 40.
My current thoughts. Hey, I'm not scared of 40. Bring it on. If I had my current head in my body when I was in my low to mid 20s, golly, how much better off would I be?
Which is what, honestly, that's what
I think
kind of conversations we have with everybody,
right?
right?
It kind of realizes that. I think. So I got in property and casualty. Among other things, we do life and health and stuff like that as well. But I got into that just because one, it's a great business to be a part of. Just because you get to actually help the community. I was actually meeting with a buddy this morning who's an agent as well, and we were just
Joe's an agent?
Yeah,
the guy that I saw at the coffee shop.
He got me into it.
No kidding.
Yeah, I've been friends with him for
okay, same organization.
Yep.
Okay.
Yeah. So
cool.
We kind of walked through it and it just worked. And it was just about, for me, it was about being a part of the community, right? Like we talk about very often, but just being a beacon in the community and being able to see the hope through Helene. But the biggest thing is creating a business. I want people when they drive by to not be like, they be say, oh, that's where Tim's office is. You know what I mean? And,
right.
Do a little bit more. So it provided a living for my family and a lifestyle, but it also provided ability to take care of the community. It's been a pretty good one so far, and Hurricane Helene's been a big piece of a reminder about why we do what we do. But yeah, there's a lot of things I think people didn't know that people should know, and just a lot of stories I'm hearing that I think it's pretty timely for us to talk about.
Yeah, no, I agree.
So.
Maybe just to kind of start us off in terms of your expertise, right? Because I view you obviously as a good friend, good workout partner. You vastly outpaced me in that, so bravo. But also in terms of the expertise side, I really look at your business and the way you approach the business and how you help your people, you stand up for your clients and customers as really outstanding compared with a lot of the industry, right?
I appreciate that.
So let's start off with just a very basic question that to me and you, in my mind, is pretty straightforward. We deal with this stuff every day, all day.
Yeah.
what is property and casualty insurance?
Sure.
Like break that down, because most people, I think they think about like auto and home or maybe renters, liability, that kind of stuff. Yeah. They don't understand like the core foundation of it's actually P&C, like in the way that we talk about it.
Sure. So property and casualty is just asset protection is the best way to put it, but also liabilities. I think we talk about auto, home, liabilities, umbrellas, things like that. And so we're looking at obviously auto and home is just how do I protect my car, right? What are the different coverages on each vehicle from bodily injury, property damage, all the way down, how they split the limits down in our state at least. Some states don't have that. But when you split all the way down from how do we protect ourselves? Because everybody thinks, kind of to start with auto, right? Everybody thinks that I have this thing called full coverage. And so full coverage is just another term for saying I have comprehensive and collision, which means that I can protect my vehicle. Yeah. Right?
Doesn't mean you're actually like set up for full replacement value necessarily. But you have all types of coverage.
Correct. Yeah. Correct. Well, and so it's that way, but full replacement coverage on a car just doesn't exist. Right. So, I mean, you have different
controversial thought. I love that.
Well, it's actual cash value, right? So it's a depreciating asset, much like not like your home is what I'm meaning is your home is an appreciating asset. So that's going to be insured on a replacement level, right? So they should be able to replace the vehicle that you have, but it's depreciating. And so when you buy your car and every year that you put miles on it, the value of that car is coming down. So you can't buy a car for $50,000 and then all of a sudden a year and a half later expect to get $50,000 back.
Right.
What's the mileage? Have you taken care of it? All those things kind of base into the value that you get out of your car. With homes, it's replacement cost. I buy my house for $250,000. It's going to continue to appreciate, and good companies will appreciate the house with you. So if something like Helene comes through and the tree falls on your house, or you have a total loss, you may have bought it for $250, but 10 years later it might be worth $325. Right. And so that's going to appreciate. That's going to be the difference between replacement value and actual cash value. And so starting with auto and home, like we talked about, the things that people find important, I think a lot of times when they're looking for just premium or just rates, right? The things that like people find important, exactly, or just that's the full coverage, right? I just want full coverage. Well, that's them saying I just want to make sure that I'm protecting my car. But the most important thing that we can talk about, if you have a good local insurance agent, is how can I make sure that if I'm at fault in an accident, that I'm protecting all my other assets. And so that's kind of what property and casualty really needs to boil down to is what can it cost me in the long run? Because I can lose my car, but that's just a thing that it may hurt. I may have to buy another one. But I can lose my lifestyle. I can lose everything I've worked so hard to save for if I don't have the correct liability limits. And so that's where I think that those are where the conversation needs to start, and it needs to be the most important part of the conversation that you have when it comes to property and casualty insurance. And then protecting your assets just is a lot of times it's going to be protecting it to make sure that I can rebuild my home if a tree falls through it.
Right.
So does that make sense?
Yeah, no, I love where you went with that already, because that's for my side, like looking at the comprehensive financial plan, working with all clients, I try to make sure we talk about the property and casualty side as much as possible.
Sure.
Especially over the past few years where home values have appreciated so much in our area.
Yeah.
Looking at, is your coverage keeping up with inflation of your home? And we'll get to that in like the 80% rule here a little bit later.
Yeah.
But think about that asset protection piece. I've had to coach so many people, and I'm not a licensed P&C agent. I like to refer that business out to people that are experts in that. Tim is. If you need help, call Tim. We'll put his contact info out there. But the big thing I think about is that asset protection side. Like the whole purpose of insurance is to transfer risk of loss.
I was going
to make sure that you can be indemnified and made whole with what that loss is. But to your point about like actual cash value on a car, just because I bought the car for $50,000 today doesn't mean that a year and a half from now I'm not going to get $50,000 paid out.
Correct.
And it doesn't also mean that you're actually going to get the value of, if you go buy the same car a year and a half old with the same miles for $43,000, which is likely based on depreciation of newer vehicles, it doesn't mean you're going to get 43. It means you could get up to that, depending on your coverage, depending on your company.
So that's why working with a reputable company is super important. It's like with anything else in life, and I think you agree with this, is you get what you pay for most of the time,
100%,
right?
Especially with financial advice.
Exactly. I mean, we're sitting. I mean, take it out of the financial realm, out of the insurance realm. We're sitting in an awesome studio, right? But these are the probably the best value mics that you can spend
for sure,
right?
Yeah.
So where if I were to have a podcast in my house, which you're already talking about, Josh, you can weigh in. I'm sure the fact that I'm not going to get the sound quality. I'm not going to get the production quality, right? Is it going to quote unquote do the job? Yes. Is it going to reach the people that we need to reach? Probably not, because the production
we suck at advertising.
Because like all the things that are there, right?
Yeah.
So it's the same thing when you work with these with some of the lower cost companies, which I understand they're gonna get some of their, they're gonna get some, but when you look at it, you're talking about the value of a car. When you go to a good company that believes in their product and is taking care of their customers the right way, they're going to be able to send you a complete it's not just going to be like, hey, I'll give you $25,000 for your car.
Right.
You can go to them and say, okay, I need the proof, right? We have to prove that. Where are our comps, right? Where are we pulling comps from? Make sure we're pulling local comps and those kind of things. And when you work with bigger, better companies, I wouldn't even say bigger, but just better companies who care about who their customers are, and not just the bottom line. Because well, I'm not going to say that, but then you have.
I know where you're going with that.
Yeah, you have other. They're going to pay out based upon the comps in the area and what you can purchase vehicles for and other things around the area, how they've gone. And so, if you do that better and you work with a better company that cares, then you're going to get a better value for your car,
right?
So, or for anything else.
Yeah, and the car's just one example that a lot of people see, and especially in the times we're in today, right? Politics out of the question, but just talking about the facts of the situation is.
Sure.
I was looking at numbers from the Federal Reserve Board that were published over the past few years, and looking at 2023 alone, the number was astounding. Where they did a study of how much of people's respective income are they actually spending on a regular basis, like month to month.
Yeah,
and the numbers were. I'm pretty sure it was 19% of American households spend more than their monthly income every single month.
Oh, that's what 30. You say 19?
19% of American households.
That number is shockingly lower than I thought.
Well,
it was
so let me go through the rest of it. Right? So like 19% of American households spend more than their income. That means if you bring in $5,000 a month, you're spending more than $5,000.
Yeah,
which means you are effectively going into debt for it, right?
Every single day you're going into debt.
Yeah, and then so that's 19%. 32% of American households spend right at their monthly income.
Yeah, that's called living paycheck to paycheck.
Bingo. And 48% is the difference, which there's some rounding in there, but 48% spend less than their income. So like the 48%, those are the ones that are progressing in their wealth journey, living below their means, have margin, able to save, able to invest, grow their wealth for the future, which is a lot of what we talk about.
Correct, yeah.
And whenever I'm meeting with someone brand new or a current client, we're talking about auto and home insurance or liability protection, the asset protection side, we go back to the fact that over 75% of Americans don't have $1,000 in savings.
Right, yeah.
And that's probably a low estimate based on the past 6 months. It's devastating, right? And this is where even if you spend a little bit more for your insurance, full circle, the point I want to make is spending a little bit more on that insurance to provide you the protection that's adequate and sufficient.
Yeah.
That's you can't get past the value when a circumstance like today comes up.
Mm-hmm. And I think so. Two parts to that. I think if you can still spend better, you can spend better educated money and spend a little more, even in those lower groups, if you decide that you're only spending good money on the valuable things. And then if we take some of those less valuable things out, you'd be really surprised of how much margin you have on a daily or a monthly basis, which at just basic, right? Like, hey, let me curb my stupid spending to spend money where it needs to be spent, and the right things. But then the other part too, you went to, somebody have $1,000, right? Mm-hmm. And look at liability is like a question that we often ask: do you want your insurance company to pay for all of an accident or just part of an accident? And that's where liability insurance comes into play. Yeah,
and that's ultimately the transfer of risk piece, right? It's like the more you pay in premiums, the more that they are signing up to pay for you. And let's use that as a transition.
Kind of, but yeah.
Yeah, relatively speaking, right? Mm-hmm. But in terms of if you adjust your coverage limits, you adjust your deductibles.
Yeah.
If you're out of pocket more, they won't have to come in as much because you're taking on that first level of risk. And then the next piece is if you're out of pocket less, like if I have a $500 deductible on something versus a $5,000 deductible.
For sure.
I'm expecting to pay more in premiums because the insurance company is going to pick up that tab.
Yeah, and I can,
rate, so.
for sure, and that was going to be part of what we talked about in the homeowner stuff. And I'll kind of motor on, I think.
Yeah, let's do that.
Yeah, so.
Motor on.
Yeah.
Very, very relevant.
There you go. So I'll break down a little bit with just where liability makes sense, and then we can move into deductibles and things like that. But
well, can we, before you actually go deep into that, just break down high level, what are the different coverages on a auto policy? What are the different coverages on a home policy? And then we can go into each of those individually. Yeah.
I can do that. So the first coverage we talk about is bodily injury and property damage. So you can see it labeled as BIPD or whatever is what, if you have like a declarations page from your insurance company, it's going to say like 250, 500, 100. 25, 50, 25, right? And those are split limits. And so in our state. And so what it is that first number it's the amount of liability of bodily injury protection per person that if I'm at fault in an accident that my insurance company is going to pay.
Right.
So let's say it's $25,000. In our state, that's the state minimum. It is not enough. Professional opinion.
Yep. Agreed.
But so imagine you get in a car accident, you hit someone else, and that person has to go by ambulance to the hospital, right? You can look up statistics on what it costs to go to a hospital, especially in emergency medicine. But from what I've seen and what I'm seeing around the area is that you're not going to get out for less than $75,000 to $100,000, most likely when it comes to all of the things that they charge, right? So now there's a delta of $50,000. So that's why it's important to have that conversation. That's the first number. The second number is the total aggregate. So in this scenario at $25,000, the aggregate would be $50,000.
So you have like the per person bodily injury liability. Then you have like for the aggregate
for the entire vehicle, right?
Like for an accident,
exactly.
So like if
I get in a car
theirs,
accident,
it's yours, it's their
Well,
passenger.
no, so this is just liability. So this is what your insurance company is paying out for somebody you've injured. This is just so the line of negligence from the claim to the accident has been drawn, and it is up to you.
Right.
And so that first number is like what you're going to pay out per person, right? What that insurance company is going to pay out per person. The second one is for the entire vehicle or for the building or whatever, person group of what happened, right? So you got 4 people in a car and you got $25,000, $50,000, $25,000 per person, but that company's still maxing out at $50,000 total aggregate for that bodily injury.
Yeah. So for example, you have 4 people in the car, you get into an accident, each person has a hospital bill of $50,000.
Yeah.
But your coverage is $25,000 per person, $50,000 aggregate total for the accident.
Yeah.
That means 4 people by 50, that's $200,000 in liability.
There's a $150,000 gap.
Exactly. Right. Yeah. Which is why, and I'm glad we got to that point, that's why I always tell people, like, again, I'm not the professional here, but I tell people you should have at least, in South Carolina, at least 100, 300, 100.
That's the minimum that's the first thing I tell people is like, look.
I prefer 250, 500.
Yes. I prefer 250, 500 with an umbrella.
Right.
That's the best way to protect, which we can get into. But 100, 300, especially for young couples that are just starting. Hey, I can't afford going all the way to the umbrella. Hey, that's fine. Let's just make sure you're protected better,
right?
And then just be smart. But as you accrue wealth and as you accrue things and assets, that you got to bounce it up because where is that money going to come from? It's going to come from wherever you have it liquid or equity in home and things like that.
Yeah, and that's where the asset protection piece is. Like, let's say that case study of there's a $150,000 deficit. Well, from a legal side, if the judge says, like, if it goes to court and all that, like, the legal side is they say, hey, you're responsible for this $200,000. Your insurance company is going to pay out the $50,000. You are now personally liable for that $150,000 difference. And that's where you have to have the protection of assets. So, like, the way I look at it from a risk perspective for all types of liability protection, including the umbrella, is for clients, hey, your net worth is $1 million. Like, you have this much in retirement accounts. Some of that's protected from creditors, some is not. We have other things over here, your home equity, like you mentioned, some savings. If you're in the situation, I'd rather you pay an extra $100 a month for 100%. Insurance so you can avoid having to pay out $400,000 from your personal assets.
It's spending pennies to buy dollars.
Exactly.
Is the way that we put it. It's, I get it. Your premiums are going to be a little higher, but when it comes down to it is when the rubber meets the road, do I want to pay out the additional $100,000? Do I have that saved away in a bank, or would I rather pay an extra, couple bucks and get the proper protection for the right place and for what I can do? Obviously, you got to stay within a budget, but hey, drive safe. Do the right things in life, and your premiums go down. That's just kind of
right.
Be a safe human, and that's
right.
and which I think most people are, and then. Yeah, you're going to save money along the way, but spend pennies to buy dollars.
Right. So let's talk about the property damage side,
Yep.
and then let's do comp and collision,
Sure.
deductibles with that.
Oh, that's right. Okay.
Briefly on medical payments.
Yeah. So property damage side is just that third number. It's the same thing. It's a total aggregate number. You know, 2550, 25 would be $25,000 of property damage. Again, I prefer everybody to have over $100,000 of property damage liability, just because you can't buy a pickup truck for less than $65,000 brand new right now. So,
and God forbid you drive your pickup truck, like, say you look down because you drop something on your floorboard, you swerve, you hit a telephone pole, you hit a business sign, you're well over $100,000 right there.
Do you know what a telephone pole costs to replace?
I don't want to know.
Yeah, it's.
I'm sure Duke Energy knows now after Helene.
$50,000.
Wow.
is what I've seen charged for a telephone pole.
Wow.
Yeah, it is. It's not cheap.
Yeah.
To replace a big wooden telephone pole.
Right.
Yeah. So that right there, if you're at 25, 50, 25, then now you're done.
Yeah.
So
right.
I've heard stories.
So on that note, the property damage, I've heard this, and I want you to correct me if I'm wrong, is like some companies will aggregate based on how many vehicles you have on a policy. Like say it's 250, 500, 100 for your property damage, but if you have 4 vehicles, effectively you could get $400,000 in property damage.
Oh, okay. No,
or how does that work?
So that aggregation is not on your liability limits. Right,
okay.
That's on your uninsured and underinsured. So,
okay,
where I'll break to there real quick. So, when you have your liability, right? So that's whatever you purchase it at, and you purchase each vehicle you purchase at that level, or however in your household. Then you've got comprehensive and collision. Those are the easy ones. That's protecting my car. Comprehensive is an act of God. It's I hit a deer, hail claim, somebody stole my car, graffiti, things like that. Not my fault. But my company still has to pay.
Right.
And collision is I was driving actively and I hit something. Right. I hit a tree. I hit a building. I hit another vehicle. That's going to go collision on my side.
Right.
And then the next part down, we also look at like emergency roadside service, and then you've got car
rental
car rental, stuff like that. But then, and those are just fringe benefits, right? We just want to make sure we're doing those things. Talk to your agent. Make sure you have those. If you don't have AAA or something like that, make sure you can get a rental car.
Yeah. So they're not required.
It's cheap,
but they're also not super expensive.
Exactly. Super affordable usually on it. The number one anger that we get, we sit down with our customers once a year, so we know that we talk about it. And as part of it, we always make sure rental car's on there. But that's the number one anger we get through a claim is I didn't have rental car, and it's like, well. It was $4 a month, and that makes sense. But going to where stackable coverages, and in our state, you can stack uninsured and underinsured. It is two different things, and this is where uninsured is a required coverage by law. So in our state, liability and uninsured are the only required coverages you have to have. The reason we have comprehensive and collision are ever required is because you have a lien on your car. You're actively paying a loan.
You have a car loan you're paying off.
Actively paying
hopefully paying off early.
Exactly. Getting rid of that, depending on your interest rate. So, but then looking all the way down, uninsured and underinsured, you usually want to match it to your liability because why would I pay for somebody else to have those coverages and me not have those? Right. So uninsured is exactly what it sounds like. I have to have a state minimum, which is 25, 50, 25. But if somebody hits me and they have no coverage on their car whatsoever, right? So when people ask, hey, why are premiums so expensive? Well, there's people driving around with no insurance.
Because Joe Blow hit somebody and didn't have insurance.
It's way more than that, but that is part. Right. So somebody hits me and they don't have any.
I'm going to jump ahead and then we'll come back. So like same thing as like everybody who saw half their neighbors getting a new roof in the past few years because of hail damage. That's why your home insurance premiums went up. Relatively speaking, we'll come back to that.
Yeah,
but
I mean, no, I think it can be connected. Yes.
Yeah.
So
we talked about uninsured. So uninsured is like they're uninsured.
Yeah. Somebody hits me, they don't have any coverage whatsoever. I get protected by my same liability limits is usually the case. Underinsured is the same thing. Somebody hits me, they don't have enough coverage. They're riding around at 25, 50, 25, right? And they rear end somebody and that person gets split off and he hits 2 other vehicles, right? Well, he's only got $25,000 in property damage coverage, right? Right. He's not going to pay for all 4 of these cars. If you have underinsured, that's where underinsured would go there instead of back to your collision. And so that way, you have another place. The deductible is usually lower. It has things inherently built into it, like rental cars, so you don't use your coverages. Okay. And then we can subrogate, which is a fancy term of saying we're going to go after the other party to collect money back. I mean, come on now.
$10 words, right?
I learned
there.
it yesterday.
You learned it to pass the exam, right? SAT word of the day.
So,
Josh, do you know what subrogate means?
I just said it.
I mean,
so was he paying attention? That's the question.
Well, I was paying attention.
We are talking
I was paying attention. It's a matter of context clues. I'm gonna guess that it's a similar to like if you're aggregating something, but it's like underneath, like under a lower category.
So I feel like he took Greek and Latin roots when he was in elementary school, which is great. I
was homeschooled, so probably.
Oh, you definitely did. Yeah. So
did.
sub means under. Yeah. Right? That's the root that means that. So yeah.
So what is subrogate?
So subrogate is when you subrogate, what you do is your insurance company will pay out, and then they go through subrogation, which is I'm going to prove all of what I paid out for my customer, and then I'm going to go to the other company or the other person who's at fault, and I'm going to pull back that money. I'm going to charge them for all those things.
Yeah.
And so when I pay out,
they're recovering their costs.
They're recovering those costs. So when I pay out all the things, then I go, but I got to prove it the right way and bring it all back. But
so I was close.
No, it's good. Yeah, kind of. Yeah, just testing you there. So the point is like the underinsured is a subrogated coverage.
Correct. Uninsured, and we're going to subrogate un and underinsured. But it's just a way that it doesn't hit your collision. Mm-hmm. And so for those of you who don't know, the things that are going to affect your auto premiums, because I get this question a lot, like, was it going to affect my premium?
Yeah, that's probably a top question you get.
Yeah. So one, your insurance company is never going to tell you that your premiums are never going to fluctuate. It's all based upon costs, right? Yep. It's spreading of it. But when you look at the things that are really going to affect, we look at chargeable and surchargeable accidents. I'm not saying they're never going to be rated, right? If you have 5 comprehensive claims in a year, expect your premiums to go up a little bit, right?
So when you say be rated, that means you have additional.
Yeah. So there's a surchargeable cost. And then there's non-surchargeable. A surchargeable accident is I was actively driving and it hit something, right? Mm-hmm. Uninsured and underinsured, in my opinion, can save you from those things because we're not going to use your collision coverage, which is where your surchargeable accidents come from, because I was at fault. So if I'm at fault for an accident, those are going to be things that hit. But when you can use those correct coverages, same thing, right? I'm not having to go back to my medical coverage, for any of those big ticket items. If somebody rear ends me and they don't have any insurance, then having that correct liability for my own bodily injury makes a whole lot of sense. Back to where we're stacking. So
I was about to pull us back. Yep.
Yeah, full circle is that when you have those coverage in the state of South Carolina with multiple vehicles, you can actually pull from, if I have 4 cars and they all have 5,150, well, on the underinsured or uninsured, I can pull those and stack those on top based upon the accident. So 5,150 can look more like 200, 400, 200.
Okay. So a good follow-up question on that is if I'm trying to manage the budget, right? Because inflation's terrible and all that kind of stuff. Would you advise to reduce your un and under?
So I will say, disclaimer, I always think that reducing coverage to save money in the terms of liability and things like that it's never a great thing. Yeah, but yes, I would start if it's I got to save money, it's a budgetary item. Excuse me, but I got to make sure that I'm in. I got to make sure that I have proper protection. If I'm running at 100, 300, 100, and I've got 2 or 3 cars, and I can break those down to 5,150 because I know that it's stackable, then that is something that that your agent should be able to help with in order to save costs.
Okay, that's good. I appreciate that. And let me clarify, because this is going to come up when we submit this for review. For compliance, Tim's not a financial advisor. He's a licensed insurance agent. He's a professional in his field.
Correct.
That is not a blanket recommendation for everybody.
Correct.
Consult
and I'm not
with
making
your
any
agent.
recommendations based on any specific companies at all. This is just upon my knowledge based upon being a licensed insurance agent in the market, and then knowing – having a lot of experience with claims before I got into insurance.
Yeah. But if you want to talk about that and get help and figure out your situation, please reach out to us. We'll get you connected with Tim.
Yeah.
Happy to make that connection and get that taken care of.
I would love to have those conversations.
Good. So thinking about that, so we talked about like what the coverages are. We talked about liability, the importance of that. We talked about, roughly the comp and collision, which is ultimately like how do you file a claim to get your car repaired if something happens? Like that could even be someone hits you in a parking lot and causes a lot of damage. That'd be like a comprehensive claim if you don't know who it is.
Yeah.
Right.
If they're just driving off, right, then we're going to file
which is
again.
Mostly what happens in a parking lot.
And in our state too, if you go ahead and get a police report, then we can file that to your uninsured.
Oh, I didn't know that.
So with that, most companies,
interesting.
As with my company, say even $500 deductible. The uninsured and underinsured deductible is usually $200. And so
great.
And so that's what I was talking about. You don't use your coverages based on you use those and underinsured.
Yeah.
So get a police report every single time.
Yeah.
If you want to file it to insurance for somebody else, because you can. A lot of times they can run it back to uninsured. So
okay.
Yeah.
So let me ask you this question, because this question comes up for me a lot, and I've had this conversation with a lot of folks in the past year on the home side, not as much the auto side, but on the home side. We'll use this as a leverage or like a leeway into the home side.
Yep.
When do I know I should file a claim?
That's a great question.
It's almost like we prepared this.
Yeah, I get that one a lot. So one, talk to your agent first. If I can say anything.
Always talk to your agent. That's the one recommendation
always
you do make.
Talk to your agent first.
Okay.
If your agent just says, I don't know, go call your insurance company because there's a lot of independent agents
Get a new
around,
agent.
right? Find somebody that cares. But that's the biggest thing. Now, I will tell you that the agent's responsibility per their guidelines are to make sure that if somebody calls and says they want to file a claim, that they file a claim.
Okay.
But you can still have a conversation with your agent. Hey, if this happens, what do I do? Right?
Okay.
Give them some plausible deniability too. It's just, but call and say, hey, if this happens, or even do say, hey, I think I might have some hail damage on my roof. That's one that we get a lot.
Yeah.
So we don't know that. And as soon as you send out an adjuster, whether they pay $0, they pay $1 million, it's going to be a claim on your record. And
right.
It's rated for 3 years. It's seen for 5. It's just how it works, unfortunately. And that's with any company, whether they paid out $0 or all the dollars. It's still a claim that's on your record. So
what you're saying is, as soon as you initiate the claim, the adjuster comes out and starts taking notes or documenting.
As soon as the adjuster
they take a photo.
As soon as the adjuster hits your property, that's going to be a claim. So
gotcha.
We can do a lot of things like file. We talk about is record only. Hey, I just want to do some research.
Yeah.
So a lot of companies will do that. So hey, I want to file a record only claim. So
does that affect your rates?
It shouldn't. No, as a record only is definitely more helpful. So
yeah,
but
did not know that. I'm learning.
Find a good local vendor, or have your agent probably has a couple. He's not going to give you one. He's going to give you 2 to 3.
Got to shop around.
Exactly. Yeah. So what I do with my customers, I give you a couple. You call who you want, and then I'd say you do not have to use anybody. Anybody that I recommend. These are just people that I know that will go look at your roof and say, hey, X, Y, and like you have this kind of damage, or I really don't think it's worth it, or hey, you might have a small patch job. So getting back to when do I know to file a claim, right?
Yeah.
So on a roof especially, hey, they can get this fixed for $1,500. Well, if you've got $1,000 deductible, it doesn't really make sense to.
That's where I would go back to. This is why we have an emergency fund of 3 to 6 month expenses.
Exactly.
That's where you would do that versus file a claim.
Yes.
Because you're going to the deductible is if the insurance company pays you out $10,000, but you have a $1,000 deductible, you're getting a check for $9,000, right? Like,
which in most cases that's a big enough to file a claim,
right?
So what we look at is your insurance policy is a catastrophic plan. It's not a maintenance plan,
right?
And so,
say that again.
Your homeowner's insurance is a catastrophic plan. It's not a maintenance plan.
Yeah.
And so what I mean by that is if my kid breaks a window, I'm going to replace the window.
Right.
Right. And everything that property and casualty related, especially with auto or with home, is swift and immediate. Right. So if I have a slow leak out of the grout in my shower.
Yeah.
Right.
Not covered.
It is not covered. Right.
Yeah.
If you have
mold, that's specific exclusions in most homeowners policies. Yeah.
If you have mold in areas, the company's going to know that, hey, they're going to do their research.
Yeah.
The one that I talk about a lot is say you've got a dishwasher, right? You've installed it yourself or whoever, but every day you go and you wipe up a puddle in front of your dishwasher just because you're like, I have no clue what that is. I'm just going to wipe it up every single day. There's a problem. We have to maintain that problem.
Yeah.
But now all of a sudden you walk in and now you've got a big buckling floor and you've got to get all of your floors in the kitchen redone.
Yeah.
Well, your insurance company is going to go and see a bunch of mold and all this buildup from behind your thing. They're going to say, hey, this isn't covered. This wasn't swift and immediate.
So I've full story, like some transparency, like from my side. So we had 4 trees hit our house, our building, our fence.
Yeah.
Cars were trapped in the garage, with a hurricane. And this is something we're going through a lot. And the conversation I had with our adjuster that came out was he said, hey, like if I come out and I see that in case of a leak, that's a good example. Like if I see that your refrigerator water supply hose or your laundry your laundry like drain hoses and all that kind of stuff, if they're 15 years old and they're dry rotting and you have a leak, well, that's a maintenance item.
Yeah,
like
it's a maintenance issue.
He actually recommended like replacing those every 3 years, which Your mileage may vary on that, but
there's a lot of things that you can do. Like, right, I mean, if you're putting hoses in your house, if you're putting in, washer dryers and things like that, use the metal. You do little things to prepare your house the right way. Don't use rubber hoses, and use the things that are going to sturdy. Going back to put money where value where it makes sense. But yeah, so if you're looking at filing a claim, call your agent first. He or she should have some vendors that they can send out and kind of get some ideas. And it's not about getting an estimate for repairs. It's just like, let's just get an idea of the damage that we have.
Yeah.
And then that
see if
way,
it's claim-worthy.
Exactly, claim-worthy. Hey, I've got an estimate that's $1,200 and I've got a $1,000 claim. It is up to you. Your risk factors are different than my risk factors. Right. So how much
everyone's financial situation
exactly,
life
but
is
just know that it is going to there are future complications. And I think a rule of thumb that I like to say is if you're worried about your premiums going up for filing a claim, then maybe your claim's not big enough.
Ooh.
So because that tells me
that
if you're scrambling, you're like, man, this is going to be a $25,000 claim and I don't have that in the bank. That's a claim.
Yeah.
Right. But if we're looking
and if your home insurance goes up by $150 a year because of that, that's a good trade-off of money. That's spending $150 more per year in the aggregate to get $25,000 in coverage.
Exactly.
Not a big deal.
If I'm going to pay it, like in my opinion, again, based on me, I like a little bit higher of a deductible. I suggest a 0.5% based upon the value of your home. Now, if you get some really, really high, extremely expensive homes, usually those people have a little bit more money. But if they're not living like that, then you can talk about the size of the deductible again based upon what your risk factors are. Where is the limit for me repairing my house?
Yeah.
I like 0.5% because if my house is burned down, I'm not quabbling over $3,000-$4,000.
Right.
Right.
Yeah.
And that's just the nature. That's just the nature of the beast. But so for me, that's kind of where the rubber meets the road.
Yeah. So one other note on the auto side of the claim, and then I want to jump to the actual coverages on the home policy because we definitely need to talk about the 80% rule. Yep. Most people don't know about that. So just one question I had on this is you're talking about estimates for the house. Your insurance agent should also have a list of like reputable and approved body shops for vehicle repairs. Like call the agent, have that conversation first. Get their recommendation. They're your trusted partner.
Yeah, I mean, and
that
don't,
kind of thing.
And don't be afraid to go to your local body shop and just get an idea of what your they may be. But they're going to have guys.
Assuming it's drivable.
Yeah, assuming it's drivable. But if it's not drivable, you're going to file a claim. Like that's easy. That's easy peasy lemon squeezy. We're going to do that.
Yeah.
But yeah, if you have ideas, usually they've heard stories of this was a great body shop. This struggled to get my car out on time, and they've kind of heard some things, and they can give you some pointing in the right direction. Hey, why don't you go talk to these guys? And also all the bigger, reputable, more insurance companies, they have people that are locked into their system.
Yeah.
If you go with those, most likely they can do all of the stuff right there and your claim goes faster.
Right.
So most of those big companies, whatever they want to call their preferred vendors, you walk in, you can get an estimate there. They can order parts, and they've already been approved by the insurance company, and they can walk right in, do all of the things, and you get your car. I promise it's faster. They put all their supplements in the right way. Everything's uploaded. Those for you who don't know Josh, do you know what a supplement is?
I'm gonna guess. So I should know this. If my dad sees this and I get this wrong, he's gonna be so mad because
Josh's dad.
For about 18 years, he sold supplemental insurance.
Okay.
Okay.
So I'm going to guess a supplement is additional coverage to fill in the gaps of your existing coverage. Yeah.
So if you're based upon supplemental insurance, then yes.
Yeah.
But what I'm talking about in a claim is supplements when it comes to, hey, I filed a claim, but the estimate that the insurance company has, and what the actual cost is going to be, they don't match up.
Yeah. So like personal example for me again is like our initial adjustment or estimate for fixing our house was $28,000.
Sure.
The contractor gave me a quote for over 60. So like the supplement is going to be if it actually costs over 60, we're going to file the difference with the insurance company to get them to agree to pay that out.
Exactly. So a lot of good information on claims is to know that the Department of Insurance, when it comes to an adjuster, will only let him adjust what he sees. That's car and home.
Let's dig into that more.
Yeah. So, for instance, if you take your car to to somebody to have it estimated, a body shop to have it estimated. They're going to raise it up. They're going to do all the things. An adjuster's going to come out. Don't touch it. He's going to take pictures of the fully around side. He's going to kind of bend his head around. He's not allowed to lift the car. He's not allowed to pull anything off. It's just what he can see. So the damage, there may be additional damage underneath, and it's the same with the house, right? That's why the most important thing in this last thing was in this last hurricane was get trees off of houses so that adjusters can come in and take an actual look. Because if a tree's laying down, I cannot see anything that's busted underneath, and I can't assume anything either. So there is no assumptions. It's all black and white. It is literally I can only do what I see. So if your contractor is most likely going to say, okay, so if this is broken, then that's going to be broken, then that's going to be broken, that's going to be broken all the way. He's going to assume those things. Right. Adjusters can't do that. That's why we have supplements. So when those additional pieces come in and they can prove it, then the amount that the company is sending out, it's going to increase. So we just have to have patience. One of the points I was going to just have patience in there and know that your company is not trying to screw you out of anything. Yeah. They have to prove everything.
Right. Yeah, because ultimately it's a contractual agreement. There's terms and conditions.
Correct.
You have to go through the process. And I want to come back to that. I realize I kind of muddled together the two topics. No. I
thought I broke it apart okay.
Yeah, no, you did for sure. Let me go back to one thing that Josh said. So about the supplemental insurance versus the supplement. So supplemental insurance itself is going to be more like you see the Aflac commercials, those kind of things like, oh, we'll cover what your health insurance doesn't cover. Or it could be like cancer policies, critical illness policies, those kind of things. So I would say that's like a separate category of insurance in general.
That's more of a health insurance thing.
Yeah, whereas we're talking about the
property
like the supplement side of claims processing for auto and home.
Yes.
Kind of thing. Yeah.
Correct. That's what I was giving them partial. I was giving them a partial points to then roll it back into the actual conversation.
Yeah, and I'm all for that. You did good, Josh. You're doing great. Appreciate that.
Stick with us.
So let's talk about in terms of all this. We kind of jumped around, did some like claim stuff. Let's go back to the actual home coverages because I think that's a thing too. Where again, when I look at people's policies and I see, I've had conversations with folks. It's single individuals in their 30s or 40s, pretty modest lifestyle, not very extravagant. I've seen a policy that had like $250,000 in special effects and personal property coverage. I'm like, do you have that much?
Like, all that has
like let's break those things down.
There's a lot. So homeowners policies are very deep. There's a lot of little things in there.
And there's a lot of different kinds.
Correct. A lot of different kinds.
HO2, HO3, H11.
Talk to your insurance agent and find out what kind they sell, right? They'll be able to let you know, right? So based on the one that we sell the very best one. It is HOW. It is completely top of the line. It's going to be replacement cost all the way down. And this is, if you have a homeowner's policy, guys, hear this. If you're making a investment into a home, I'm looking right at you, camera 2.
Yeah, there you go, baby.
If you're making an investment into a home,
say it louder,
right? And you're putting your money in that thing and you're growing equity and you're doing all those things. If you don't insure it the right way, that's the one thing that can take everything from you. Think about paying a mortgage for 30 years on a house that cost $300,000 and it was the top of your budget, but then you're going to go to a small insurance company because their premiums are lower and then they don't pay out the proper replacement costs, or your deductibles way higher than you thought it was because you didn't look at all the right endorsements, or you just don't have the proper coverage if something's not covered. Well, now you're paying a $300,000 mortgage for 30 years on a house that you no longer have because the insurance company declined the claim. Yeah. So know what's in that policy and make sure that it's proper replacement cost coverage. So that's where I'll go. So bringing it back full circle so you don't have to pull me back in. But
you're fine. And let me just throw in another point there before we go through that. Is that's a situation we're seeing with a lot of folks that have, like, I consider myself fortunate with the storm. Yeah. We had a lot of damage. We're out of our house for several months. That's okay. Our neighbors, not as fortunate, right? Like, or we have friends and family and clients in Western North Carolina that, like, their house is on the side of a mountain. The mountain doesn't exist anymore. Like, those are much worse situations, and that's where those are more extreme, and we don't need to go too far down that path, but like those policies don't cover flood. They don't cover earth movement based on certain factors.
Correct.
Really understanding what kind of policy you have is important because there are different ones. Like I forget the actual numbers, what they correlate, but there's some that are just for condos. There are some that are just for rental. There's some that are for investment properties.
Yes, exactly.
Like
HO2s, HO4s, HO6, all these different things.
Right.
Every company's going to just call them something different. Most likely they don't know the number.
But if you pull out your actual documents, it'll say
just look at the actual coverages on your house and make sure it's the right thing for you. Make sure it's covering the asset the right way. It's what it's based upon. And then much different than cars, we all talked about actual cash value, right?
Yeah.
With your homeowner's insurance, it's an agreed upon value. Like that insurance contract is an agreed upon value of the max that your insurance company will pay. So for a total loss of your home. Now, good insurance companies, when you insure for 100% of that, when you insure for the full replacement cost value, which your agent will build in whatever tool that they use or however they do it, when you insure at 100%, the better, more reputable companies are going to give you an extra 15, 20, 25%, 30% on top of that value. So where does that mean is, just to keep numbers even, say I have a $100,000 home and it's $100,000 replacement cost, and I insure it for that. Well, my insurance company is going to give me an additional $20,000, let's say, for 20% to insure that home. So if something is undershot, you still have the additional value there. So that's where that replacement cost actually comes in. And so kind of to round that back into the 80% rule, which we talk about is like your insurance company wants that replacement cost in your home. And most companies, if you insure it for less than 80% of that replacement cost, they're not going to give you that full replacement cost anymore. Now it's going to be actual cash value.
Right.
And so that's where the cost of goods and everything, like the wood and all those things and your roof, right? Nobody wants to depreciate a roof, right? Imagine that you've had a roof for 25 years and it's depreciated by 90%. Oh, why even file a claim for a roof? Like, let's make sure that it's replacement cost at the start. But you do lose that 20% if you come down under 100, though.
Yeah,
if
so
that makes sense.
Yeah, so let's. I want to make sure that's clear for everybody. Yeah. So like the way that I've understood that and explained it to clients is let's use some numbers. Like we'll say 200,000 was the purchase price of a house.
Sure.
Okay, so 100% replacement value. Replacement value being what does it cost today to rebuild that house? So if you bought a $200,000 house, let's say in the Greenville, South Carolina, upstate area, right? Predominant area we live in.
Yeah.
Home cost $200,000. You bought it 6 years ago. Now, if you were to rebuild that house, it costs $450,000. Very realistic in today's terms. We bought our house for $175,000 in 2018.
Yeah.
Our estimated or like Zestimate value is I don't know, $295,000 last time I looked.
Sure.
Recent appraisal we got was $295,000. If I wanted to rebuild that house in entirety, it would probably cost more like $375,000 to $400,000. So the catch there is like if you had the $200,000 house and all you did was when you bought the house, you bought a policy that just did the $200,000 value because that's what the appraisal, that's what you purchased it at.
Sure.
And you didn't have any kind of inflation hedge, additional endorsement or rider that keeps up with inflation.
Yep.
And you had a total loss situation or even a majority loss situation. And it would cost $400,000 to rebuild.
Yeah.
But your coverage is $200,000.
Yeah.
The insurance company only has to pay out $200,000.
It is a replacement level contract, and that's why so with my company, as with most companies, I will say, especially the better companies, they're gonna keep pace of the index, the indexes that are pushing those home values up. So a couple things I want to touch on with that is replacement value versus purchase value. Those are two different things.
Okay, yeah,
right?
let's break that down.
You don't insure purchase value. We insure replacement value. So it's okay if they don't line up. And so because we also don't insure land, right?
Yeah.
So
because there's nothing to insure.
Exactly. you may be buying a 100 acre, let's say 25 acre piece of land with a 1,200 square foot house for $1 million. Well, you don't need $1 million of homeowners insurance, right? That's not what it's going to cost to rebuild that home.
Yeah.
And so that's where you want to look at that. So of replacement versus purchase value, right? We want to do what the actual replacement. They're usually going to be close, but then based upon what your rates are, good companies keep an index that are going to increase that every year. That contract is going to increase, and that's why you might see a raise in premiums and things like that. Because you are correct, if you have a lower company that doesn't increase that index at all to where cost of goods and replacement and all that, then you're gonna you're going to be really upset when they give you a $200,000 check.
Yeah, and it costs $400,000 to rebuild.
Otherwise, if your company's bringing the value of your house up by, whatever that percentage, 15 to 20% every year, then you're going to be in the right place, and then you always recover that with your agent on a year or every other year basis.
Right, which is why you definitely would have that conversation with your agent, even if it's a 10-minute phone call to say, hey, home values around us have gone up. Are we okay? They say yes. They say no. Reevaluate.
Yeah.
But so go back to the actual 80%, right? So we said house is worth $200,000 when you bought it, or the cost to replace whatever was $200,000. Several years later, it's $400,000 to replace. The 80% rule comes into play is if you have coverage like your coverage A, your dwelling coverage.
Yeah.
My understanding is it's coverage A for most policies.
Yeah.
If you have at least 80% of the replacement value in coverage. So in this case, 80%. So $320,000 and it costs $400,000 to rebuild. If you have at least $320,000, they're going to pay out the full claim for whatever that amount is. But if you have under the 80%, they don't have to pay out the full amount that you actually have in coverage.
They're going to depreciate everything that you have, right? Because you got to think inside of that, everything that covers in the policy, just go to coverage A, right? All of the things inside of that, like I said, so into the roof, right? The shingles are depreciating over a 30-year time frame.
Yeah.
And so that's where, they're not going to give you full replacement value for that $200,000. It's going to be, you're going to have to prove all of those things, and then it's going to be, everything you get is going to be depreciated. Hey, you can buy it for $100. Well, it's depreciated 50%, so we're going to give you $50.
Yeah. So
that's where the 80% rule really makes a big impact.
Okay, and that comes back into play with like the supplements, right? So like if you had like you get your adjustment for your home. We'll just talk about homes instead of vehicles right now. So like adjustment for the home. Let's say your repair costs adjusted by the insurance company was $40,000, but they're accounting for $10,000 of depreciation based on how old your roof is.
Yeah.
You have the material costs, all those kind of things. But if you get everything fully repaired, and you submit the proof that it's been fully repaired, and you submit the invoices and all that with the supplement, then they actually give you, correct me if I'm wrong, they'll give you the difference of what that depreciation was because it's now
because it's a replacement level.
Fully replaced.
Replacement cost. That's the difference in actual cash value and replacement level.
Which goes back to when you file a claim, actually get the work done.
100%.
Don't just pocket the cash. That is insurance fraud, right? But actually get the work done.
Well, your insurance company knows it too, right? Because, hey, I didn't send out that second check, so I know. So to touch on that in a minute. So when you are over 80%, you get a full replacement cost on your stuff. So keep it at 100%. People just do it the right way. But the first check you get out, if you look at your estimate, your first estimate is a actual cash value, or your first payment is an actual cash value payment.
Right.
So when you see the estimate, it's going to say
exactly
this is the replacement cost, this is depreciation, this is your deductible, and this is your payout to start. So you'll see that you could see the depreciated value. If you're under that 80%, hey, we're done. Right. If you're over that 80%, then like you said, show the proof, and the rest of that. You show the proof that you had the repair done, and the rest of those funds for the replacement cost are released back out to you to make you back whole to where you only paid your deductible.
Right.
And so, so that replacement level value, that second check is a big one.
Yeah. So don't leave money on the table. Is
exactly.
The key thing.
Get the work done, because that's what you're insuring.
Right. So and if you don't do that, then that looks pretty poorly, I would assume, for the insurance company side. They say, hey, like this person filed a claim, we gave them some money. They didn't go back and fully bring the property back to good standard. So,
then we can't insure it anymore.
Right. Yeah. There you go. Hey, thanks so much for tuning in for part 1 of this incredible conversation we had with our good Five Forks good neighbor friend, Tim Gajda. This has been so deep, so detailed, lots of content, lots of information we've been able to record and document for you guys today. We're going to come back with part 2 in another episode we're going to post. Make sure to go back and find that on all of our channels and where we post this podcast, social media, etc. You're not going to want to miss the end. We definitely cover some great topics and some detailed information about coverage and how to handle claims and those kind of things. But join us for part 2, and we will see you there. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.